Hello and welcome to this short video explaining how you can read an annual report or really any type of financial report in under 5 minutes by looking for the 7 key things straight away when you open the document. Firstly, where do you find an annual report? You'll find it on the company's website, or if you want speedy access, go to your brokerage account or the stock exchange which the company is listed on. For example, if you're investing in Australian companies, you would go to the ASX website or to your brokerage account to find the information you're looking for. So what's the first thing that I would look at in an annual report? Well, the first thing that I would look at when you open it up is typically the thing that's at the top of the annual report, which is the chairman's or CEO address. And typically this is kind of like a letter written from the top management of a company to the shareholders. Now, they can vary in length, particularly for larger companies that can be quite long, but you could probably get the bulk of what you need to understand from a chairman or CEO letter within the first 2 pages. So you can skim read through there and try and identify anything that jumps out at you, where they've said things like mistakes or things that didn't work well or things that did work well. The second thing I'd look at, which is a little bit further down in the annual report, is something called the Remuneration Report. Now, this section of the annual report shouldn't catch you off guard if you have done your research. However, I find it is very, very important when you are looking at a new investment idea, or if you're just keeping track of the incentives of the people that run the company you invest in or that you own. So what we're looking for here is principally 2 things: the relationship between the long-term incentives or LTI and I guess the short-term incentives or the cash that these managers and CEOs and board members receive from one year to the next. Now, the next thing that we're looking at is, did the board of directors actually go to meetings? Now, this is something that you might not think about straight away, but there is often a table in the remuneration report which sets out how many meetings were held by the board of directors that year and how many were attended by each individual. Keeping in mind that some of the directors may not have been with the company for the full year, so you can't necessarily say because they haven't attended all the meetings that they were absent for unusual reasons. But what we're looking for here is simply, did the company's top management team actually attend the important meetings? Now, that's something that you should be asking, particularly of smaller companies where those decisions are typically made at these meetings, and they're typically crucial to the long-term success. The next thing is, obviously, we're going to start looking at the financial statements. And the first one is probably the least important for me, which is the income statement. And at the very top of the first statement that you'll see in an annual report, you'll find revenue or sales. That's obviously a good way to put your finger on what the company is reporting from one year to the next. At the bottom of the income statement, you will find net profit. So between the top and the bottom, there's a lot of water that goes under the bridge in a typical company. If you're trying to get a quick take on the income statement, what you're looking for is obviously, is there growth from one period to the next? But what you're principally looking for is any anomalies. Is there anything that is unusual? So a number that has increased dramatically or fallen dramatically that has influenced what's happened from the revenue line at the top all the way down to the profit line at the bottom. Has maybe a big one-off cost jumped up? Is there a number of citations or short little footnotes that then point you to a note in the accounting statements, which you have to follow up and try and interpret? The next thing is obviously the balance sheet. And most people think balance sheet, they think debt and cash. And those are the 2 things that I would be looking for straight away, particularly if my company has any debt whatsoever. So you would be looking at the relationship between short and long-term debt, those 2 put together, against cash in the bank. And obviously that gives you an understanding of how much dry powder does this company have if something goes wrong, and maybe what is the, leverage or the risk inside this business if things don't go well for, say, 3 months, 6 months, or the next year. The next statement, which is probably my favorite statement and probably the most important if you ask value investors, is a cash flow statement. And it's typically the 3rd or the 4th statement in an annual report. And what it shows you is your cash flow from 3 different activities. Keeping in mind that cash flow is different to reported profit because of accounting standards, the one thing that you're looking for is free cash flow. But free cash flow will not be present on the cash flow statement. You have to calculate it yourself. And I do that very quickly with some rules of thumb. What I do is I get the operating cash flow or the net operating cash flow line item, and I subtract anything that is a capital expense, so capital expenditure. And you get those figures from just a little bit further down on the cash flow statement within the investing cash flows line item. So you'll see this big middle chunk of the cash flow statement. You're looking for things that are long-term investments like property, plant, and equipment, and you get the operating cash flow and you take away that property, plant, and equipment, and you have a quick read on free cash flow, which is arguably the single most important financial metric of any company. Finally, we have in the notes the accounting statements, and then there's often in the notes you'll find all of the, you guessed it, notes that detail how the company goes about putting together their financial statements and what you see. This is very important. It's very, very important for you to read the notes of the accounting statements if your company reports a lot of non-cash revenue or non-cash expenses. You'll know what I'm talking about if you've looked at financial statements before, but basically you're looking for anything that could explain why cash flow is so different to profit. But that's not what I'm looking for here. In the notes of the accounting statements, there is one particular note that I always look to, and it's something called the segment report. And the segment report, often called the operating segments, shows you what's under the hood of a company. So for example, let's say you have a big blue chip company that has a big brand name, but underneath that it has 5 different divisions. Well, most companies would show you the results for each of the different divisions, so all 5. And they're typically presented in a neat accounting statement called the segment report, and that is buried in the notes. Why would I be looking at the segment report straight away? Well, because it tells me, is one of these businesses doing well? Is one of them doing bad? Are all of them doing bad? Are some doing well? Some doing better? You're looking at the segment report for those answers. And the final thing that you're looking for, which probably goes without saying, is an auditor report. Now, an auditor report is typically issued when you have, well, audited statements. So they might not necessarily be available straight away with the announcement that your company puts onto the share market. Make sure you're looking for the audited reports. When they come out, they might come out a bit later. And what you're typically looking for here is the auditor's declaration, which is this thing that's kind of set down halfway down the annual report. And what you're looking for is not necessarily a good thing, you're looking for any bad things. So if the auditor has identified something that's not in compliance with accounting standards, because that obviously raises the red flag for you. Okay, that was a lot to take in a very short video. Let's just go over it. We've got the chairman and CEO ladder, typically at the top. We've got the remuneration report, and we're looking for the number of meetings and the relationship between long-term and short-term incentives, typically about 1/3 of the way in. We're looking at the income statement, revenue versus income over the year. We're looking on the cash flow statement. We're trying to calculate just with our, we're just going to eyeball it, the free cash flow. Remember, that's operating cash flow minus property, plant, and equipment or long-term investments. And then we're looking on the balance sheet. What's the relationship between cash and total debt, including any other kind of liabilities that look like debt. In the notes, we're going straight to the segment report to try and identify any businesses that are performing exceptionally well or are performing poorly. And finally, we're going to go to the auditor's report to make sure that we have a declaration that says there are no issues with the company's reporting to accounting standards. That's the video. That's how you read an annual report in a very short period of time. You can also do this, use this technique to apply to half-year reports or even quarterly reports. One thing to keep in mind is that if you own a share or a company in your portfolio, you should be reading the whole annual report. So this is just a quick take on the annual report, but as always, you should be going through it with a fine-tooth comb, especially those financial statements. Thanks for watching this video. I look forward to seeing you in the next one.